Hey everyone, welcome to question 3 of the TAX219 main exam. So we've got the question split into two parts. So part A, first of all. So you can see in the question here, Chin Chin, Australian resident, has migrated to Canada on 30th of September 2018. So he ceased to be an Australian resident at that date. And they've given us a list of assets down here. He's also got carried forward capital losses down here. So as usual, we're skipping to the question now. So identify the relevant capital gains tax event, calculate the minimum net capital gain or maximum capital loss for Chin Chin as a result of the CGT event, show all workings, provide a relevant section reference for any exclusions. Okay, so it's 11-mark question, not too difficult. So straight away what we can see what the question's asking us is we're talking about CGT first of all, because he's selling assets, or he's disposing of assets. Number two, it's to do with a resident becoming a non-resident. So we know that this is going to relate to the certain tax provisions in here. So if we go to the CGT chapter in our ultimate notes in critical file. So whenever you see those words, you see a list of assets and you see a resident becoming a non-resident, you're going to know that that triggers basically a disposal on assets that aren't TAP or TAP. So what TAP is taxable Australian property. So basically, if it's an asset that's not a house, it actually results in a capital gain. I say house, but it could be land, it could be mines, and so forth. Okay, so let's go back to the question. So we know what we're going to be have to looking at. Let's just revisit the question, because it's very important that we tick all the boxes, we don't miss anything and lose some easy marks, and we're answering exactly what the question is asking us to do. So in this case, what we have to do is identify the relevant capital gains event. So straight away we know what the event is going to be. It's going to be this over here. So it's going to be this event. CGT event L1. Is it an L or an I? Right, so the first thing that we're going to do to answer this question is we're going to identify the relevant capital gains tax event. Now I've got this little work paper over here. You can see I've set up my table. First of all, the asset or event that's occurring. The capital gain. Now the reason I've split the capital gain into two columns is because some are going to have the CGT discount if you hold it for 12 months, some aren't, and rather than in every single calculation going divide by 2, we can just do it all at the end of the total. So that's why we've got the two columns there. We'll just add them all up. And for those greater than 12 months, they get the discount. We'll just divide by 2. For these ones, we'll just sum it up. And then, of course, section reference. So don't forget, in the tax module, section references are critical. They're very important. Any line you do, you need to have the relevant section applicable for it. And that's it. So let's focus on the first one. So the relevant capital gains event is going to be, as we saw in the notes over here, it's going to be CGT event L1, I believe, which is a deemed disposal. So that's all we're going to write there. I'm just going to copy this, CGT event L1. So that's the first part of the question. The second part of the question is calculate the minimum net capital gains or maximum capital loss for Chin Chin as a result of the CGT event. Now we might want to add in a column here that says notes or something like that, just so we can explain what the CGT event is. And I'm just going to copy and paste this from our notes over here, the critical file notes. And there we go. So CGT event L1 deems a disposal of all CGT assets for market value at the time an individual stops being an Australian resident. Might actually post it over there. Okay, so let's move on. The next thing we have to do is we have to post all the relevant assets or CGT of assets and what's their treatment. So the first one we're going to look at the digital camera, because we need to do this to calculate the minimum net capital gain. So the first asset we're going to look at is the digital camera. Now, with CGT event 1, for any non-TAP assets, So it doesn't apply to TAP. So this isn't taxable Australian property because the camera is not property, which means that a deemed disposal would have actually occurred under this event. So the next question is, are there any exemptions that apply? So we need to go back here to our capital gains, have a look at our CGT exemption. So this is actually a personal use asset. It's a camera, right? So straight away I can see over here under my exemptions that personal use assets acquired for less than $10,000 do not have CGT event applicable to it. But because we purchased this for greater than $10,000, see we purchased it for $11,000, there's no exemption applicable. So that means the capital gain is going to be $12,500, which is the price or the market value, less $11,000. So it's going to be $1,500. Now, have they held it for greater than 2 years? The answer is yes, because they acquired it in 2015. You can see over here. So we're going to put it in this column over here. We're going to go 12,500 minus 11,000. Now at the end, once we get to the end, we can divide them all by 2 because they get the discount. But for now, let's just leave it like that. Now, of course, the section reference, we can never forget the section reference. Now, the main section reference we want to refer to is the fact that personal assets acquired for less than 10,000. CGT is ignored when acquired for less than 10,000. So we want to put in that section reference there. So we're going to go. I'm just going to copy and paste this. So there is our section reference. So that's full marks so far. All right, let's move on to the next asset, which is going to be the stamp collection. Okay, so first of all, we need to look at what exemptions might be applicable. So we know that stamp collections would be a collectible, right? So the relevant section that we're going to be talking about is this, collectibles. So for collectibles acquired under $500, so this is going to include artwork, jewelry, antique, coin medallion, books, rare, postage stamp, first aid. So just be really careful with this one, because just because it's called a collectible or identified as a collectible doesn't mean it is. So collectible only includes these things. So basically, for a collectible, CGT is ignored when acquired for $500 or less. How much did this collectible cost? Let's have a look. It cost $350, so there would be no CGT on this one. So the answer is going to be 0 for this one, and the section reference that we want to pull in is going to be this one here. So CGT ignored, so it's going to be this one here, section 118. So you can literally just copy and paste it from the notes, paste it into your exam, and that's how you get full marks so far. Okay, next one is rental property in the United Kingdom. So property in UK. So the first question I have is this taxable Australian property? Because if it is, then CGT wouldn't be applicable in this situation under CGT event L1. But is this taxable Australian property? No, it's not. Even though it's a property, it's not in Australia. So therefore, it's not taxable Australian property. That means CGT is applicable, which means a disposal has occurred, and we need to actually include this as a capital gain. So the way we're going to calculate this is we're going to go market value less the cost base of the asset. So it's going to be 405 less 400. But hold on, is the cost base just 400? See over here in the notes over here, we've got division 43, capital works deduction in relation to this building is $5,000 per year. So what that means is they've actually, and we'll go back to the notes soon, but basically for any capital works deduction on the building, you need to actually adjust the cost base of that asset. You're going to have to reduce the cost base. So basically, the way it works is you get a deduction, immediately, but it means later on down the track, you pay a higher rate of tax when you actually sell the property because your cost base is going down, so you can have a capital gain there. So the process we're going to have to do here is we're going to have to actually figure out what the cost base is. We're going to have to take the $400,000 and we're going to have to minus it by $5,000 per year. And to do that, we're going to need to figure out how long they've actually owned the asset and then apportion it so we can apply $5,000 per prorated year. So, first of all, how many days has this, years has this been held?
So that we want to go to the triggering date, which is going to be 30th September 2018. So we need to know how many days there are between 30th of the 9th, 2016, when they acquired it, and 30th of the September 2018. So they bought it in September 2016, so it's exactly 2 years. So basically, it's going to be 5,000 times 2 is, so they're going to reduce the cost base by $10,000. So the cost base is actually going to be $390,000. So the capital gain is going to be 405 minus 390,000. It's going to be 15,000. Now the next question is, which column does it go in? The first one or the second one? Well, it's going to go in the first one over here, and the reason is if it's been held for 2 years, it's been held for greater than 12 months, and therefore they would get the capital gains discount on that. So we're going to go 405 0,000 minus 390. That gets us to 15,000, and the section reference that we're going to apply here is probably just the division 43 capital works deduction that we've got over here. So let's just go division 43. That's fine. Okay, so moving on to the next asset, we're going to go vacant land in Sydney. So this time it actually is taxable Australian property because it's property and it's located in Australia as well. So because that's taxable Australian property type, basically CGT is exempt. So the answer is going to be 0. Now in terms of the section reference, we're going to need a section reference here. So let's just go back to our main CGT tab over here and go to the section on foreign residents and CGT, and we can basically just take the fact that we'll take section 04160, which is the overall subsection about residents becoming non-residents and how this doesn't apply to taxable Australian property. Okay, moving on to the next asset, so electronic tablet. Electronic tablet. Okay, so let's go back to our CGT exemptions tab over here. And what we know is that the asset's actually a personal use asset. It said so in the question over here. Oh, personal use. So what do we know about personal use assets? Let's have a look through this list. So we already used this one before. Basically that CGT is ignored when acquired for less than $10,000. So that's not applicable. Oh, sorry, it is applicable here. Because they've only, they bought it for 1099, so that's not applicable. Oh, hold on, sorry, it is applicable. So there's no CGT, basically, because they bought it for less than $10,000. However, we have an issue here because they're actually going to have a capital loss on this because the market value is less than the cost of acquisition. So they're going to have a negative 699 capital loss. So let's just finish reading through these rules. So third element of cost base doesn't apply, so it's not really relevant here. And then this one here, no capital loss for personal use asset can be used to reduce gains. So this one's important. So instead of recording the capital loss of 699, what we're going to do is we're going to disregard it because it's for personal use. So we can actually have to go 0 here as opposed to a capital loss. And the reason is because of this section over here, section 108.-20.1. Okay, last asset that we've got here is the BHP shares. So what do we know about the BHP shares? Are they taxable Australian property? The answer is no, but that doesn't mean shares can't be taxable Australian property, because they can, because in the notes, if you start looking through what the definition of taxable Australian property is, it means it can actually be an entity that holds an underlying asset of taxable Australian property, but you need to hold greater than 90%, which isn't the case for BHP. So this is not taxable Australian property. And it's not a personal use asset or anything else like that. It's just shares. So they're just going to have to record a capital gain. So the capital gain is going to be 20,000 minus 12,000. Now the next question is, have they held this asset for greater than 12 months?
to figure out which column it goes into. And the answer is they haven't held it for greater than 12 months because they've held it for 2 months to get to 2018 and then another 9 months to get to the end of September. So basically they've held it for 11 months, so not a full year. They need to have held it for greater than 12 months to get the discount, so that's basically going to be 0 in this column, but we're going to get 20,000 minus 12,000, and that's it. So there's no particular section reference for this. You could potentially just reference the general section 6014-60, which is just resident becomes non-resident. Okay, so the final step is they've also got down here, so Chinchin's got a carried forward capital loss of 7,000 and has not made any elections for income tax purposes. So we also need to add all this up. So let's just add in a total. Okay, so we've got our totals there. The next thing that we need to do is we need to apply our capital losses and then apply our CGT discount. So we know that the capital losses apply before the CGT discount, so we're just going to apply those now. So capital loss first. So we know from the question he's got a capital loss of 7,000. So let's just apply it against these first of all. Minus 7,000. And then our net like that. And then what we're going to do is we're going to apply our 50% CGT discount. So we're going to go equals minus times 0.5. And then this is going to be our net capital gain. $8,250. I'm going to change this to subtotal to avoid any confusion. So there we go. 8,250 plus the 1,000 is going to be a total net capital gain of 9,250. And that's basically the last part of the question, which is calculate the minimum net capital gain. Show all workings, provide a relevant section reference for any exclusion. So we've done that, we've provided all the section references, we've identified the relevant capital gains event, we've calculated the capital gain, the net capital gain for Chin Chin, and we've shown all workings. So that's a full 11 out of 11 mark question. All right, moving on to part B, which is a 5 marker. Okay, let's have a read through this question. So Ethan is an individual who does not carry on a business. In July 2017, he acquired a partially furnished residential property. Included in the property were the following assets. So during the year, Ethan acquired the following new assets. So he bought a table, a rental property, software, a microwave. Okay, so his effective life of his assets are in line with this, the useful life. So what is required is to calculate Ethan's maximum decline in value deduction for each asset for the income year. Show all workings. Okay, so we basically need to calculate the depreciation value for each of these assets. Okay, so it's effectively a depreciation question, otherwise known as Division 40 depreciating assets. So you'll be able to find that in your critical file notes on section 5, capital allowance, which is another name for Div 40. So when you think Div 40, it's things like, you might have a table, you might have furniture, you might have, other things. The other alternative is capital works, and that's more like buildings, right? That's when you've constructed a certain building site or whatnot. People get confused between these two, capital allowance, cap works. So capital allowance is always like equipment, capital works is always building. Okay, so this one should be fairly straightforward. It's only worth 5 marks. So there's 4 assets that we need to identify, and how to treat
properly. So furniture, but not just any furniture. It's furniture that when he acquired a property, it was included as part of that property. So you know that they've given us such a specific situation that we need to apply a specific rule. Now the other ones aren't as, they're a bit more generic. So we've got a table here that he's purchased. Note that it's a fairly low purchase price, less than $300. So, we should be thinking about, is there an exemption for a low cost asset? Next one is a rental property management software. So the amount is a bit higher, so it's probably not to do with cost, but note that the asset is an intangible asset. So software, there might be some specific rules around software potentially. And then microwave. So, it's not less than, it's not a small amount. There's nothing unusual about it. So it could just be a standard one. But when we're thinking low cost, and it is kind of low cost, we should be thinking about pools, so cost pools, because you can get a more attractive rate for them. And the question actually requires us to get the maximum decline in value deduction. So not just any method, the method that results in the highest deduction or the highest depreciation cost, basically. And we also need to provide a relevant section reference for each asset. Okay, so the thing with this chapter, Div 40, is that the rules and deductions are quite specific. If you have a look through this chapter, I'd recommend reading through it yourself in detail or watching our video on it, see down below. But yeah, it's just a series of really specific rules, and that's what makes these questions quite tricky, is because I'll give you very specific scenarios, and then you have to find the specific rule that applies to it. So the easiest way is to just read through it and understand the different situations that are commonly assessed. So what I'm looking for right now is this specific situation about acquiring an asset as part of a property. So the section reference that we're actually going to use over here is, in your notes down here, is an individual investor, so non-business related, cannot claim a deduction, a decline in value, for a second-hand asset purchased and used in residential rental properties. So that's the exact situation that's applicable to here. The answer is basically 0, because even though he would typically get a deduction of $8,000, roughly, which is just that times your divide by 5, and then times the 200%, which is, there's the 200%, the diminishing value. We actually have to reduce it to 0 because of this rule down here. So section 40-27. So the answer is quite simple. It's actually 0. And the section reference we're going to apply is section 40-27. So that's basically 1 mark there. So let's set up our table. So here we have our table here. So the asset is going to be furniture. Deduction is going to be nil. And then the section reference we mentioned was section 40-27. So I'm just going to copy that across. Boom. First question is done. Okay, so next one is table. So we mentioned before, what's kind of unusual about this asset? Well, it's the cost. The cost looks really low in this question. So we want to look for an exemption that allows us to actually, well, let's figure out what it actually says about these low cost assets. So here we have over here, down here, low asset immediate deduction for non-business assets. So we've got to make sure that it's a non-business asset. And if it is, and it's less than $300, which it is, then you get an immediate deduction. Now note that it's GST inclusive, so this is an area that people can get caught out on. So let's say it was $299 plus GST. Well, then it wouldn't fall under this threshold. So, but I don't see anything about GST, so it's okay to use. And we just make sure that none of these other criteria don't impact it. But otherwise, this looks fine. And the section reference we're going to use is this. So what we're going to get is we're going to get an immediate deduction. So we're basically going to claim the $299 straight away. So this is going to be the table. Okay, cool. So we're making good pace here. Next one is the rental property management software. So we've got software. Now that's the thing that you should be looking for, is the fact that it's actually intellectual, well, not intellectual property, it's intangible property. So possibly there's some specific rules around that we need to consider. So if you look up here in terms of effective life, taxpayer cannot self-assess effective life where a particular asset is statutorily prescribed. And what that means is it's set out specifically in the Income Tax Act. So these are generally to do with intangible assets. And you'll note here that it says that we must use the prime cost method when calculating their depreciation. So the first thing to observe is that for software, the effective life is actually 5 years. It's prescribed as 5 years. So in the question, it gives us to us as 3 years. Well, that's incorrect. It needs to be 5 years. And it needs to be done doing the prime cost method up here. So we're going to have to recalculate it ourselves. So it's basically going to be equal to 1,500. So that's the cost of the software. Divide by 5, which is the number of years. And that's it, 300. So if you're not sure what the formula is for prime cost, it's in your notes. And it's also got the different method as well. Where is it? Here we go, prime cost. So it's basically just asset cost. Divide by, we need to apportion it for the number of days you've held it. But we've held it for a full year, so we don't have to do that here. Times 100%, or 1 over asset's effective life, which is what we've done here. So you'll note that you don't have to times it by 200% as you do with the diminishing value. Okay, so that's the rental property management software. Have we got the relevant section reference? Can't remember if we copied it across. No, we didn't. So just pasting that in there. And then the final one that we have to do is just the microwave. So I mentioned before, we could just do a straight 600 divided by 4 and apportion it from the date of acquisition. However, that doesn't necessarily result in the highest maximum decline in value. So technically what we should be doing is calculating calculating all the methods available and seeing which one results in the best approach. So because we've only held this for 30 days of the month of the year, the calculation I'm going to show you what it would be is going to be equal to 600 divided by 4. That's the yearly amount that we also need to apportion it by 30 days over 365. So that's basically, they get to claim $12 under that method, which is the prime cost method. But we need to assess other things. So I mentioned before, we know it's a low cost asset. It's less than $1,000. Let's have a look here. So we got, if we did theoretically apply it to a pool, and if you're not sure what a pool is, watch our video on depreciation and capital allowance down below. Basically, a pool is where if you apply this rule, it means you have to apply it to all future assets you buy under $1,000. There's two types of pool. There's low cost and low value. Low cost is basically when you buy an asset that costs less than $1,000, and then low value is basically when an asset costs more than $1,000 has been depreciated less than $1,000, and everything depreciated on $1,000 comes into this pool, this low value pool. So this would be a low cost asset because it costs less than $1,000. And basically the rules here is you need to use diminishing value, not prime cost. And in the first year, and this is something that people get tricked out on all the time, is you don't just apply 37.5%. In the first year, you actually apply 18.75%, and then every year after that, you can apply 37.5%. So basically what we need to do here is we need to go $600, which is the value of the microwave, times 18.75%, and we want to see which one has the higher deduction value. Is it going to be the $12 over here, or is it going to be the 600 times 0.1875, $112? So obviously 112 is greater than 12, so we're going to use that method because that's going to result in the maximum decline in value deduction. And the section reference that we can use here, let's use this one over here, section 40-30. And that's it. Probably the only thing that we need to do at this point is just to total it up, because you note that we've only got 4 items here, but we've got 5 marks. Probably just total it up, and there we have the maximum decline in value deduction. So that's full 5 out of 5 marks for that question. Alright, now let's just quickly finish off with part C, and that'll be the end of question 3. So what we have to do here is Alyssa Pty Limited is a resident company and small business entity taxpayer. Has acquired the following assets for its business. So APL wishes to maximize its deductions for the income year ended 30 June 2019
it has chosen to apply the small business exemption capital allowance rules. So the question requires us, so it's only 4 marks, calculate APL's total deduction for decline of value for the income year ended 30 June 2019. So this question is to do with small business exemptions, specifically for capital allowance, i.e. depreciation. And it's actually quite tricky because these are quite current tax rules which are changing all the time. So if you have a look at the SBE chapter in your notes and go to SBE concessions, you can see there's all these different rules depending on when you bought it. So basically it used to be 1K up to 2015. Then it was an immediate deduction for depreciating assets costing less than 20K. And that was for the period from 12th of May up until Jan 2019. And then they increased it to 25K for the period between Jan 19 and April 19, which was only like 4 months. They increased it to 25K. And then after that, they increased it to 30K for the period from 29th April to 30th of June. So it's always changing, and now after that period, they've increased it to 150K. But instead of getting an entire immediate deduction for the asset, you get a choice, whereas you can either get a 50% deduction on the cost, or if you're using the simplified depreciation rules, you can claim 57.5% of the cost of the asset. So they made it really complicated and changing all the time. So just be careful with this one. Just be conscious as to when in the question they're actually buying the asset, because a different rule might apply depending on when they bought it. Okay, so let's have a look at these assets over here on the right-hand side of the screen. So we've got machine 1. They bought it in July 2018. So that would fall in this. So as long as it's less than 20K, you get an immediate deduction. And then machine 2, they bought it on Feb 2019. That would fall under this category here. So the threshold would be 25K. And then this last one here, June 2019, that would fall under this category up here where it's going to be less than 30K. So that one, they'd actually get instant depreciation for that one, whereas these ones up here, they wouldn't. Now, the other consideration is the taxable usage. So generally speaking, with capital allowance, only the taxable use component you're going to get a deduction for. The non-taxable use component, you don't get any deduction for. Okay, so basically, we know what we're going to have to do. For the first 2 assets, they're above the threshold, so we can't actually get that instant deduction. And what we're going to have to do is we're going to have to apply it to the small business depreciation pool, because that's going to result in the best outcome for them. So basically, what happens with the small business depreciation pool is, as you can see down here, in the first year, you get a 15% deduction, and then every year after that, the opening pool applies 30%. So for those first 2 assets, we're going to do that. We also need to apportion it by their taxable usage as well. Now for the last asset, we're just going to get an instant depreciation write-off, and that's fine. So what we've got over here now is we've got a little work paper ready to go. So machine paper, we need to show our workings over here. So basically what we're going to do, we're going to go 27,000 times the 15% that we talked about as being part of the small business depreciation pool. And then we're going to find the relevant reference for this, which is going to be the 15% over here. So we're going to take that, copy in that, paste it over here. And that's it. Next is our machine number 2. So again, we said that that was above the threshold for the instant write-off. So what we're going to do is to go 35,000. Again, we're going to times it by 15%, times 0.15. However, we also got to times it by our taxable usage. I mean, technically we were meant to do that for the first question as well, but it's just times it by 100%, so it's not going to make a difference. So this time we're going to go times it by 0.8, and there's our answer there for 200. And we need our section reference in here as well. It should be fine to use the same section reference there. Okay, moving on to the next one is the car, and this is the one where we said it was actually under the threshold. And so the immediate threshold we're going to take is this section 328-180. We're going to insert that there, and basically it's going to be the full amount, so the 29,990. And if this was only like 80% taxable use, we'd have to apportion it by that as well, but it's 100% taxable use. So that's our answer there. And then total it up again so we can get our full 4 marks, because there was only 3 elements to the question. And that's basically how you get full marks for part C and also for the entirety of question 3. Okay, I look forward to seeing you in the next video where we'll go through question 4.